Hello, I'm Peter Warburton, Director of Economic Perspectives, and welcome to this latest podcast on the topic really of the revival of credit growth in the Eurozone and the US. For quite some time now, we've had a regime of very low interest rates. We've had a regime not only of very low money market interest rates, but increasingly compression of bond yields across the curve, culminated in some extraordinary developments in the European bond markets over the last 6 months, taking 10-year bond yields below zero in the case of Switzerland and almost to zero in the case of Germany and some other countries. But let's just step back a minute and think what this dramatic sequence of events has done to the behavior of credit aggregates, particularly lending to the private sector or borrowing by the private sector from the bond market. So for the past few years now, what we've observed is that whilst bank credit growth was still rattling along in double-digit growth in Asia, and occasionally being reasonably robust in America and some other large countries, but the soft spot was the Eurozone. Bank lending growth in the Eurozone was negative for most of the last 3 years for most of the countries. It seemed that there was nothing that would bring back a revival of credit growth in the private sector. Basically the whole policy settings didn't seem to be conducive to this change. And what it led to was that the banking system, in order to sustain some balance sheet growth, was lending increasingly to the public sector. In other words, it was acquiring the obligations of the public sector in order to maintain just a basic level of balance sheet expansion. All that has now changed. In the last 6 to 9 months, a number of European countries have seen a dramatic change of pace in terms of private sector borrowing. Clearly, what is behind this on the one side is an easing of credit conditions, the willingness to lend, and on the other side, eagerness to borrow at what are now impressively low interest rates. For quite some time, the compression of sovereign bond yields wasn't really getting transferred to the borrowing cost of the private sector. In Germany there were, and maybe you could say Austria, Netherlands, some other countries too, but not for Spain or Italy or Portugal. This is what's changed. That what we've seen is drops of 20, 30, even 50 basis points in the cost of borrowing over quite a short space of time, and the European Central Bank survey suggests that this loosening of credit conditions has further to go. What we've seen is a pickup in demand in France and Italy and Spain for this credit, and we've already seen quite a remarkable turnaround in some of the bank lending aggregates. So for the Netherlands, we're now into double-digit bank lending growth from declines not long ago. For France and Belgium and Germany, now quite sort of decent single-digit growth rates from zeros before. Even in countries like Italy, the negatives have become less negative. And we anticipate bank lending growth in Italy will turn positive very soon. So what does this mean for the outlook? It means that the first quarter growth in the Eurozone of 0.4%, so annualized about 1.5%, is not a fluke. Basically, Europe is throwing off some of the torpor and lethargy of the last few years, and we confidently expect Eurozone growth to get quite a bit stronger through the course of the year, and into 2016. So you might ask, well, how can this possibly happen with Greece on the brink of default with respect to its IMF payments? The short answer is that the Greek context matters most for the euro, not for these domestic credit contexts. So to the extent that the Greek falls into some kind of lapsed state in terms of its credit payments, I think that will be bad for the euro, but not bad for demand conditions in these other countries. There is no new information, essentially, in the Greek situation. Not only has bank lending growth picked up, we've also seen bond issuance by non-financial corporations and even by financial corporations and banks picking up as well. So basically the turnaround in credit is really quite remarkable, and without attributing it to a particular aspect of ECB policy, there is definitely a change of mood. The story in the US is a little different. Certainly there are some question marks over the robustness of credit growth. Currently bank lending growth is now about 8%. Some of this will be distress lending to energy companies that have drawn down their credit lines. Some of it will be a diversion of credit to people seeking to take bigger positions in the equity market. But I think stripping all this away, what we see is that there is a change of behaviour in the mortgage market. We're starting to see mortgage applications shooting up now. We're starting to see household formation strengthening. A lot of signals that it's not just car loans and student loans that are bolstering these figures. So the conclusion that we have is that there is a new visible upturn in global private sector credit growth, and we'll be writing about that in our forthcoming publication. Thank you for listening to Economic Perspectives.